This module covers things that are not usually found in your textbooks in estate planning or charitable gifting in your classrooms, and it's called Private Operating Foundations, which is a type of private charity or foundation, and it's very useful in the real world, and there are many of them, so let's get right into it. Our objectives is to describe what a private operating foundation is and what it isn't, list the qualifications to be a private operating foundation, describe why a CPA is required for compliance, and list a few disadvantages to starting a private operating foundation. Obviously, there's a few disadvantages, there's a lot of advantages, aren't there? And that's what we're going to find. They're applicable for many clients. It allows the client to choose what charities they want to support and even deal directly with the activities. It's flexible and easy to set up. As short as 3 days can be set up according to the experts. However, I think everybody I've dealt with suggests assistance of a CPA to help with the tax rules, and if not a CPA, an enrolled agent. And finally, there's major tax advantage over the normal type of private foundations that you see in the textbooks. Taxes on the private operating foundations are subject to a net investment income tax as well as other requirements and restrictions that you have for foundations. Another way of putting it, there's more restrictions on operating foundations. They're not subject to the excise tax for failure to distribute income, however, and 50% of the AGI cap for charitable income tax donor rather than the private foundation cap of 30%, which is very important because if I'm a normal private foundation, I make gifts to it as a 30% maximum out of AGI. With the operating foundation, I get 50%. The compliance issues: to qualify as a personal operating foundation, I must meet the income test. I must meet one of the following tests. It's either an asset endowment or support test, running 3 years following a 4-year period ending with the tax year, or a combination of all 4 years meeting the above test. And we'll cover the test in the following slides, but realize that this is really done by a CPA or an enrolled agent. You're not expected to do it, but you're expected to work with the CPA and or enrolled agent as well as your client. The income test met if its direct operating expense counts at least 85% of the adjusted net income. Now remember, when we talk about net operating expense, that can include many expenses that are associated with such things as travel, entertainment, even salaries of people. It doesn't necessarily mean it's all going to the public charities. And the adjusted net income is defined as the excess of gross income for the tax year determined with certain modifications. And there again, you require the CPA or enrolled agent to assist you in coming up with these calculations. The asset enrollment and support test: at least one of the following tests must be met in addition to the income test. Asset test requires 65% of the foundation assets devoted to exempt activities. Enrollment test requires 2/3 of the foundation's minimum investment returns used for exempt activities, or the alternative support test must be made with 3 additional criteria. Again, we don't go into the details because you need the CPA or enrolled agent who's trained in it to do it. And we would not expect a financial planner to spend the time getting involved because it's not worth it for you. But you have to know about it so you can let your clients know what's involved. It's very expensive to set up and very expensive to monitor, but it has a lot of benefits, such as the 50% rather than 30% limit on AGI. Combination test: it's an alternative to the assets endowment and support test. Covers all pertinent amounts of income or assets held, received, or distributed during the entire 4-year period. And for new private operation foundations, obviously cannot meet the 4-year period. Thus, a new foundation must meet the following 1-year period. It must have an income test. It must be one of the 3 other tests: asset, endowment, or support. We have a status check will continue for its 2nd and 3rd tax years to make sure it satisfies the combination method. And failure to meet the above means the IRS will treat it as a private foundation, which again loses that benefits we talked about of the extra 20% you can put in. I might note that administrative costs for any foundation is very high because of the way these set up, and can be very beneficial to the owners and the persons who set up the foundations. There are disadvantages to setting up a private operating foundation. First of all, high overheads compared to private foundations. You have a lot of paperwork you have to do, and you need the CPAs, and probably larger ones would have a CPA full-time working for them. You have inflexible, complicated tax rules. It's very rigid. You fail to comply, and you're thrown back as being treated as a public foundation. You cannot have self-dealing, which is interpreted very broadly. In other words, you cannot set up the foundation to benefit yourself. That's a good way of putting it. Prudent investment rules applies to all investments, which again, if you go there with the prudent investment rule has a lot of strict requirements and fiduciary responsibilities. State laws can be challenging, and thus Delaware Corporation or Trust is recommended by the accountants and lawyers. It's probably the only state to set it up in. You can't own part or all of the family business with the foundation, which is, in a regular foundation, the foundation can take over the business that you have. So let's say I have the lease you business. I cannot have a foundation. I can have a foundation take it over, but not a private operating foundation. And contributions cannot be made for political causes, interpreted very broadly. Whether it is or not, that's another issue, because a lot of times, let's face it, politics gets into anything. Why is a foundation grant money spent? Or where is the foundation money spent? Well, 29% for education, which I found very surprising. This is from 2014. Human services is 17%. When we talk about arts, culture, and humanities, 12%. Public social benefits are 11%. Health is 9%. International foreign affairs is 7%, which surprised me. I didn't even know foundation spent money in that area. Environmental and animals is only 5%, which surprised me because of the big emphasis on the environment today and animal rights. Religious related also was smaller than I expected, 5%, and then miscellaneous beyond that. So with a private operating foundation, you got a lot of flexibility in who you're giving to, and we can see where the money is actually spent. In summary, we learned the importance of documentation to obtain the tax advantages. It's needed to properly allocate funds to obtain tax advantages. And again, you need a CPA on that, or an enrolled agent. The ability of a private operation foundation to choose the beneficiaries of the gifting, which is very flexible compared with what you would find in a private foundation. And the advantage of better tax treatment than a regular foundation. And let's face it, we like tax benefits, don't we? That's one reason people get involved in one.